Okay, so we have variable costs for this product. Variable cost is let's say 200. All right. So now the question is, if I want to determine the ideal transfer price from our last video, remember, let's say that this division P, buying price, how much you can buy from external market. Let's say buying price, you can buy this product at 280. So my ideal price, the selling division will always set the minimum price, and the minimum price is simply set by just looking at the capacity and the external demand. So first thing first, I need to get the excess capacity. The excess here, excess capacity here is the difference between the capacity, what they can produce, and what the external is willing to buy. And the excess capacity in this case is simply 100 units. So, and I said in that video, please, if you have not watched that video, go to that video, please, and just get the basic understanding on this area. All right, so this 100 can only be sold at variable cost. It means that for this 100 units, so I would say ideal price, ideal transfer price for the 100 units, all right, is the minimum is how much? Minimum price for this is 200, which is the variable cost. 200 up to the maximum is how much this guy can buy from external, which is 280 up to 280. So the price for this is between 200 and 280. Remember that division P is actually requesting for how much? For 500 units. 500 units. Out of this 500 units, we can only sell 100 units at this price, right? This price range. So in this case, the remaining 400, the ideal price, transfer price for the balance of 400 units, all right, is at opportunity cost. Opportunity cost, which is practically like the external selling price. External selling price. And the reason is simply because if this division K sells anything outside this 100 units, right, below this external price, their profit will actually fall. Why? Because external market is willing to buy as much as 1,100. It means that to maximize their profit, they will be selling this 1,100 at external selling price. So if they must sell anything to internal division out of this 1,100, it means that they must be transferring it as opportunity cost. Reason being that if they don't do that, their profit will actually be reducing, because if they are selling to internal division, it will probably be lower than how much they are selling to external market, and so their profit at the end of the day fall. So in this case, this external market is now how much? Selling price is 300. So if I want to now look at transfer pricing based on opportunity cost, all right, transfer based on opportunity cost. Opportunity cost. What I'm doing here is simple. I will say this is division K now. Division K. I want to get their profit statement, and then I have their sales. Their sales, the sales will be split into two: internal sales and then external sales. What is the internal sales in this case? The internal sales here, internal want 500 units. But out of this 500 units, I know very well from this ideal price that this 100 units should be sold at variable cost, and so at minimum. So I would come and say 100 100 units multiplied by the variable cost for this product is 200. 200 plus. Now, they want a total of 500. Don't forget, internal want 500 units. 500 units. I've sold 100 units at variable cost. At variable cost. The balance to make it 500 is 400. And that 400 should be sold at external price, which is more like the opportunity cost, multiplied by how much is the external price? 300. And so this will give me external sales. I've sold a total of 500 out of, look at now, I've given them 500 out of 1,200. So 12 minus 500 should be 700. So of 700 will now go to external, and so I would have 700 units multiplied by the external price is 300. And so if I do this effectively, 100 times 200 plus 40,000, and if I do this also, that should give me about 210, 300, yeah, 210,000. So the total sales for this division is simply 350,000 naira. All right, so this becomes the total sales if it's based on opportunity cost. Based on opportunity cost. I hope it's getting clear to you. So all we have just done simply, the number one step is to determine the excess capacity. What's the excess capacity here? Difference between what they are producing and what external is buying from them, willing to buy from them, which is 1,200 minus 1,100, and then I get 100. That 100 units should be sold at variable cost, and which is 200. Variable cost is 200. 100 at 200. Internal wants a total of 500 units. All right. So out of this 500, I've sold 100 units at 200 variable cost. The balance must be sold at opportunity cost or external selling price, right? So what is the balance? To make up this 500, it means I need 400 more multiplied by the external selling price, and that gives me 140. So the amount that we go into external sales is the difference between what you have given to internal in total, which is this 500, and the total capacity. So if I take 500 out of 1,200 units, that should give me 700. And of course, that 700 is sold to external market at how much? 300. And that gives me a total of 210. And then I have grand total of 350. This becomes the total sales for this division. Remember that this transfer price is based on opportunity cost. Based on opportunity cost. All right. So please help me with this and put your answer in the comment section, just to show that you understand what we have done. What is the total sales for division P? Division P, if transfer price is based on opportunity cost. Opportunity cost. All right, please put the answer in the comment section. All right, so the capacity is 1,000, external demand 800, internal demand 500, external selling price is 200, and variable cost is 150. Determine the total sales for division P if transfer pricing policy is based on opportunity cost. All right, thank you for watching. In our next video, we'll be looking at a full question on transfer pricing, ACCA and ICANN, that is based on opportunity cost. Thank you for watching. If you're just joining us, please subscribe to our channel, and see you again in the next video. Thank you.